So yeah, I'm Paul Lawson-Tyres. I'm one of the advisors at BDH Sterling, and I'll be taking you through everything today. Michael Hart is here from. Are you there, Michael?
Yes, I'm here. Good evening.
Hi, Michael. Yeah, from Halo. He'll be talking to you today about the currency control. So, first of all, just to take you through. First of all, Michael's going to do the currency for you. We're then going to talk a little bit about pensions, Qrops, and the transfer process. What different types of pensions there are, and why you may or may not transfer them. And then there'll be time for questions and answers afterwards. So please feel free to use the question and answer tab on Zoom, and we will then answer the questions at the end of the presentation. So first of all, introducing you to Michael.
Yeah, thanks a lot, Paul. So yeah, good evening, everyone. My name's Michael Hart, and I've been working at Halo Financial for 12 years now. So have been there a while, and started off helping private clients move their money between currencies, and then a few years ago moved more into sort of the partnership side of things. But essentially been with Halo for a number of years, and I've helped a lot of people like yourselves move from well, in this instance from the UK to Australia. So enough about me, more onto sort of who Halo Financial are. We're essentially a currency broker, so we help people move money from one currency to another, as there's a lot of money to be saved potentially on the exchange rate that you move your funds across at. We're very much customer focused, and it's a very consultative approach, so it's really taking you through the process from start to finish. So we have helped thousands of people move their funds across over the years. So we've got a range of FX solutions that essentially manage your risk, because that's what it's all about. We're not claiming that we know exactly where the market's going to go and we're going to make you loads of money. We're just saying, this is your situation. You've got one currency here and you need to buy another currency. Let's manage the risk of currency fluctuations for you. So I'll go into a bit more detail on that in a second. But yeah, so we've got a dedicated team of consultants. As I say, I was one of the consultants for 7 years, and I was probably one of the most junior guys on the desk. So yeah, they've been doing it for a long time. So you're in very safe hands when you're using Halo. But to add to that, of course, we're FCA authorized, so we've got the highest levels of regulation possible. So when moving money with ourselves, you know, it's fast, safe, and secure, of course. So we just moved on to the next slide. These are sort of different products that we offer. So first of all, you've got what's called a spot contract. This essentially is, if you did move the money through your bank, how it would be done. All we do say is, or encourage you to compare the rates. So ask your bank what rate they'd be, for example, buying Australian dollars at, and compare it with ours. And we're reasonably confident you'll be quite pleasantly surprised as to the difference. Because, you know, this isn't just your holiday money moving across. If this is your life assets, a very small difference in the exchange rate can make a huge difference to what you receive at the other end. We also offer what's called a forward contract. These are quite popular when, say, for example, you're moving to another country and you haven't sold your house yet, but there's a favorable exchange rate available. You can essentially lock into an exchange rate in advance with a deposit, and then settle that up to 2 years into the future. Also for regular currency transfers, and these work in both directions as well. So it's quite often that you may say still have some needs to move money from, say, Australia back to the UK on a monthly basis for a mortgage you may still have here, or a loan, or whatever it might be. It's quite common that you need to move relatively small amounts in either direction on a monthly basis. and you can just set that up with ourselves to be completely automated, so that you don't have to worry about that £250 a month credit card bill that you still need to pay, or something like that. So they're pretty useful, and it just saves you a lot of time and worry when you're moving to a country, because let's face it, you've got enough of other things to be thinking about. So getting your finances in check is in advance is one more thing to tick off the list. So as far as actually sort of monitoring the markets, we obviously can provide you with guidance as to certain exchange rates that we feel are achievable within your time frame. The migration process doesn't happen overnight, as I'm sure you probably all know. So we try to use the time between now and when you're actually moving, or even the time between you moving to Australia and you're not buying a house for the first 6 months. It just, whatever your time frame, we can work to targeting a certain exchange rate for you. And this is done through what's called a limit order. So for example, sterling Australian dollar over the last 12 to 15 months, has had sort of lows of about 175 and highs not far off where we're at the moment at just around that 190 level. And that's the thing, on £100,000 over the last year, at one point you'd have got $175,000, and other points you'd have got $190,000. So it's a big old difference as to what you actually could be receiving, just purely on the time in which you lock into an exchange rate. So you can say to us, okay, well, I'm not in a rush on these funds. I've seen sterling Australian dollar has been up at 2 previously. Let's target that exchange rate. Or if you say, okay, well, actually, I need these funds in the next 3 months, we'd say, okay, well, actually 190 isn't far off the highs we've seen. Maybe just target that level. So they're very good tools to try and get a little bit more on the exchange rate using the time you've got between now and when you actually need to move those funds across. Equally, their job to manage your risk on the downside. So we can do a stop loss, where essentially that's just reducing your risk and saying, okay, well, what's your worst case scenario? These are quite useful for property purchases. So, if you're buying a place in Australia, it can get to the point where we say, well, actually, if the exchange rate goes below this level, we can no longer afford to buy this property. So we can put measures in place that say, okay, well, no matter what, you will still have enough Australian dollars for the purchase of the property that you're looking for, or even may have put a deposit down on. So, because the last thing you want is to essentially have agreed to purchase a house, and maybe pay a deposit, and then all of a sudden there's a sudden drop in the exchange rate, which does happen. The world is a funny old place these days. So there are big swings in exchange rates. So the last thing you'd want is not to be covered against that big move and potentially losing deposit or whatever it might be. It's just giving you peace of mind, basically, and managing your risk. And then, watch orders is just if there's an exchange rate you've got in mind, we can just notify you when we get to that level. So if we go on to the next slide, it's just to sort of summarize our top tips, really. So there's no harm in registering with us straight away. There's no cost or obligation or anything like that. We can just essentially get you on our daily or weekly, or even do a quarterly update if it's still relatively early stages for you. We can just keep you up to date with what's happening in the currency markets, and then at least you've got sort of an idea of what's going on and how we can help you. Biggest tip is don't leave it till the last minute. The number of people that have called us from Heathrow Airport in a panic trying to get their money moved across. Well, yes, of course we can do it at very short notice. Really get the benefit of our service. The more time we've got to play with, the chances are the better exchange rate that we can get for you. It's as simple as that. So start planning in advance. Get things like orders and stop losses in place, or at the very least just to get going, get signed up to our currency updates so that you're in the loop, so that when when you are ready to move. There's no big surprises, and we can assist you getting your funds moved across to Australia. So yeah, that's essentially all from me. I thought I'd keep it relatively short and sweet. If any of you've got any questions, either now or towards the end, then feel free to do so. My Halo email address is at the bottom there as well. So feel free to just send me an email if you've got any questions, because these kind of services is quite a personal service. So we dig down into your personal requirements, what you need and when you need it. So yeah, feel free to get in touch. And yeah, thanks for listening today. That's all from me.
Thanks, Michael. Just to give a bit of backup on that, my parents-in-law moved to Spain a few years ago, and I talked to them about how they were going to manage their ongoing pension income that they had coming in. I'd asked them about whether they had a currency broker, and they didn't know anything about currency brokers, so I recommended that they set up an account with Halo. And the way that I always put it is, I'm a financial advisor, and that was advice to my parents-in-law. That's one piece of advice you do not want to get wrong. Needless to say, they have been delighted with the service that they've had from Halo. So I do highly recommend their services. So taking you on to a little bit about what we do at BDH Sterling. One of the main areas that we tend to concentrate on for people is their pensions that they have in the UK when they are moving to Australia, and just working out what they need to do with them. It tends to be the area that is most complex in terms of the planning and in terms of understanding pensions in the UK on their own, let alone what implications there are by moving to Australia. So first of all, just to take you through the different types of pensions in the UK and whether or not you can actually transfer them to Australia. And when I talk about transferring, I'm talking about transferring them as a whole lump sum over to an Australian scheme from which you would then draw. Let's have a look at the different types of pensions. So first of all, the ones that can be transferred to an Australian superannuation fund. First of all, you have company pensions that you might have been part of as part of your employment. You have private personal pensions and SIPPs that you might have built up as well. They're the sort of ones that sort of fluctuate according to what's happening on the markets. And then you have DB schemes, defined benefit schemes, and I'll take you through the difference between defined contribution and defined benefit on the next slide. But essentially, they're the sort of ones that in the past were always called final salary, but these days you have things like career average revalued earnings type schemes as well. Looking at the column of schemes that can't be transferred, the UK state pension can't. That would be paid out to you from the UK state pension, and then you just have to manage how you transfer the money over. A lot of people keep UK bank accounts open so that they can have the money paid into a UK bank account, and then they can use the services of Halo to then pick and choose the time that they go into dollars, giving you a little bit more control over the exchange rate that you get. There are certain government unfunded pensions. So what we mean by this is they are defined benefit schemes, they're final salary type schemes, but they come as part of employment for certain government departments. And the reason they're called unfunded pensions is because they don't have a ring-fenced fund for that particular pension. The contributions that you make go into the general government coffers, and they can then budget how much they're going to have to pay out in benefits each year. Now, for those people that are a member of these schemes, I do apologise, but this happened a few years ago. It is not possible to now transfer from these schemes. They are the NHS, Teachers Pension Scheme, Armed Forces Pension Scheme. I noticed there was a question in the question and answers already about that. The police, the firefighters scheme, and the civil service pension scheme. Now, if you are a member of the local government pension scheme, that's a different matter. That is classed as a funded scheme. So the local government pension scheme is split between various different schemes. Like, for example, you've got the West Midlands scheme and the Greater Manchester scheme. So you can transfer out of those, and whether or not it's in your interest to do so is a different matter. We would need to look at that fully, but they are possible. But those 6 government-backed schemes, again, NHS, teachers, police, armed forces, firefighters and civil service, are the ones that you can't transfer out of, unfortunately. Then you have company pensions that are in the pension protection fund. So again, these are defined benefit type schemes, but they are ones that were struggling so much with their funding that they ended up having to go into the pension protection fund. Now, you will know if you've got a pension in the pension protection fund. You will have been informed. You will have got lots of literature about it, but they are locked into the pension protection fund once they're in there. Also, company pensions that are already paying out to you a pension, they are again locked into that pension scheme. They will continue to pay that income to you. Of course, it will be in sterling, so you'll have to manage your currency conversion. And the same thing with annuities. If you've purchased an annuity with your money purchase pension fund, then you unfortunately can't transfer that either, because it's already locked in for the rest of your life. So I said that I'd take you through defined contribution and defined benefit. Well, I've already kind of mentioned it anyway. The defined contribution scheme is defined by the contributions that you've paid into it. So you pay contributions in, they then get invested, and it depends how much those investments grow to by the time you get to retirement, and the choices that you take at retirement as to how much that can provide you in terms of income. Then you have defined benefit. And within those type of schemes, the final salary schemes and the career average revalue earnings schemes, those types of schemes, you will have a defined benefit. You will have a defined annual pension, and it will be based on the years that you were in the scheme and your salary. So that's what determines it, not necessarily the level of contributions that you've made, although additional contributions can sometimes buy additional service and additional voluntary contribution funds that are more like a defined contribution that sit alongside the defined benefit. But with a defined benefit, you never have a fund value. If you're exploring a transfer to Australia, you have to apply to them to get a transfer value, and that's what we would work with to then determine whether or not it was in your interest to transfer. So why consider transferring your pension in its entirety to an Australian superannuation scheme? Well, Michael's just been talking to you about the exchange rate. This shows how much it moves around, this graph, over the years, and it can be useful to be able to transfer your funds in their entirety into Australian dollars on one occasion. That way you've got a fund that's sitting there in Australian dollars, paying you Australian dollars, and it makes it a lot easier for you to budget rather than having to contend with a pension that's coming out of the UK and is going to fluctuate in this manner during your retirement. A couple of other reasons why you might transfer. One of the reasons might be that with estate planning, you might find that the benefits offered by a superannuation scheme in Australia, when I say superannuation scheme, that's just what they call sort of personal pension type arrangements like we have over here. So you might find that they provide a better benefit than the benefit that you get at the moment, particularly if you're in one of those defined benefit type schemes. And your scheme might be underfunded, and you might be worried that it might go into that pension protection fund that I was talking about earlier, which does reduce your benefits a bit. So that might be a consideration. There's lots of different considerations. You may also find that you want to have a bit more control over your investments and the way that you use them in your retirement. So, transferring them over to an Australian scheme, it would then be invested, and when you get to retirement, what happens generally in Australia is that you remain invested throughout your retirement and you just draw income from that fund. So, it gives you a bit more control over the levels of income that you draw, etc. And this next one is a very important point, and it's the tax treatment of an Australian scheme. So if you are living in Australia and you're drawing from a UK-based scheme, you are going to be taxed in Australia, or at least subject to tax. Whether or not you actually pay any, it depends on the thresholds, a bit like in the UK. But you will be subject to tax on that income. If, however, you transfer your funds to an Australian scheme, well, Australian schemes work in a different way to the UK. They don't provide as much tax relief up front. But because of that, all the benefits that you receive from an Australian scheme, once you get past age 60, are tax-free. So you're in this unique situation where you've had your tax relief over the years from your pensions. You've had tax-free growth in the UK. You can now potentially transfer them over to Australia and get everything tax-free in your retirement. So that's certainly a big plus. As well as being able to get those funds into Australian dollars. As I said, it's not going to suit everybody. Sometimes it's actually in your best interest to leave the funds in the UK and pay tax on them, because you'll still be better off, particularly if you're in a defined benefit scheme. But we have to take every case on a case-by-case basis, because it does differ from client to client and from scheme to scheme as well. And also, it might be a chance to consolidate your pensions. I'm a financial advisor, and up until a few years ago, I had 5 different pensions dotted around until I actually consolidated them myself. A bit like a busman's holiday, having to do that sort of stuff in your spare time. But a lot of people are in the same situation where you've been at a couple of different jobs. You might have some private pensions as well. It's a good opportunity to get it all under one roof, all invested consistently. It might also reduce your charges a bit as well in certain circumstances. And there's the opportunity, as I said, to get those funds then into Australian dollars as well in a more tax efficient environment. Before you transfer to your funds to Australia, particularly if you've got a bit more time left in the UK at the moment, it could be a really good opportunity to look at actually paying additional contributions into your scheme. Because when you pay a contribution in the UK, you get basic or higher or even additional rate tax relief on that contribution. Now, if you get that tax relief, you've then got that additional boost to your savings that you don't necessarily get through something like an ISA, and you can then have those funds invested in a tax-free environment in the UK for the moment. And then eventually you can get them over to Australia and get everything tax-free. So you never give back the tax relief that you got up front. For once, you get to get one over on HMRC. It doesn't happen very often, so take advantage while you can. That's what I say. But it can be a really good boost to your savings. So rather than you sort of getting basic rate tax relief of 20%, for example, in reality it ends up being a lot more than that because of the growth that you get over the years, and then the fact that you don't pay any tax back at the end. It's a big advantage compared to somebody that was going to live in the UK forever and a day. In Australia, they do tax growth on funds as they go along, and there may be some tax to pay on the growth element of your fund when you move it over to Australia. But it's only at 15% if it's done in the right way, and it still means that you can be much better off from paying contributions now and then transferring over, because that's only on the growth. Okay, so I've told you all the reasons why it is a good solution for you. Now I'll take you through a couple of the reasons why it might not be. First of all, it's not always cost effective. It depends on the size of the fund that you've got as to whether the fees involved, like for example with working with ourselves, with setting up new schemes in Australia, whether it's going to be worth your while. But if in doubt at all, just contact us. We can discuss it with you. We can work out what can be done, and we can also look at other assets and in combination with that as well, things like investments and that you have that might be able to bring down the costs. You might find that the current scheme that you're in the UK is the performance is outstanding on it, and you might not be able to replicate it elsewhere. That would be something to look at again on a case-by-case basis. You might find that there's early exit fees from your policy. That would apply to a personal pension type arrangement, or unlikely company schemes, but some old arrangements may end up having early exit penalties. So it's not necessarily a case that you don't transfer to Australia. It just now might not be the right time. It may well be that those exit penalties reduce over time, maybe even get removed at a certain point. So it'd be a case of looking at that and working out the timing of when you're going to do things. And also, if you're in a final salaries type scheme, if you do transfer out, you will be taking on the investments of those funds that you transfer out. You will be taking on the investment risk. It will depend on how those investments do as to what that fund can provide to you in terms of retirement benefits. Whereas all the time you're in a defined benefit type arrangement, you don't have those risks. Okay, so if you are under age 55, you can't transfer to Australia. The minimum age is 55. That will probably go up to 57 in 2028 when the minimum pension age goes up in the UK, because it's the UK that imposed this age 55 rule on transferring to Australia. So if you're younger than that, that doesn't necessarily mean that we can't we can't do some work for you in the meantime, because we can potentially use a self-invested personal pension in the UK, where we can actually bring Halo into your pension so you can move into Australian dollars whenever you wish to, and invest in Australian dollars within that scheme as well. Or you can leave it in the current scheme. It's worth investigating doing some restructuring in the UK though, because again, you may have quite a few pensions dotted around. Might be a decent consolidation exercise as well as bringing in that currency control. So I mentioned the SIPP there. It's simply a self-invested personal pension. So it gives you more type of options as far as investments are concerned, and bringing in somebody like Halo into it. It just means that you can bolt on lots of different things to it. They have a similar product in Australia called the Self-Managed Super Fund, although it is slightly different in the nature over there. In the UK, you go to a pension provider and you complete application forms. In Australia, you have to basically set up a new scheme from scratch. You have to do the trust deeds, you have to do the reporting to the Australian tax office, etc. But it can still be a very suitable solution for people, and we do have offices in Australia that can help you to set that up and to run it. I'll take you through that later. Okay, so I've already gone through that. So the transfer options age 55 onwards. That's the point at which you can start to look at transferring your pension funds over to Australia. From that point, you can transfer them over there. There are limits on how much you can transfer in each Australian tax year, but we can manage that if you've got a particularly large fund over different tax years. But the main thing is, if your pension goes to an overseas scheme, it has to have qualifying recognised overseas pension scheme status, Qrops status. And that is an HMRC term from the UK that gives an overseas scheme permission to accept UK funds, and they have to agree to adhere to certain rules during a certain reporting period. So just moving on to Qrops just a little bit more. I won't labour this point too much. They've only been around since 2006. During that time, before that time, it was quite hard to transfer a pension to an overseas scheme. Since then, it's become a lot easier. That was the purpose of the legislation for Qrops, and it allows you to transfer abroad. Now, it used to be a lot more constrictive than it is in terms of what you could then do with your Australian scheme. There are still some limitations, but not to the extent that there were. But yeah, there have been legislation changes over the years. As I said, it was introduced in 2006. Over time, HMRC has then had a look at how that's actually working, and as with a lot of legislation, they've made tweaks over time as to what they need to do with that. Back in 2015, that's when we had the problem with unfunded government schemes, when HMRC stopped you being able to transfer out of the NHS, etc. That was also when they introduced the age 55 rule. Before that, we could transfer to Australia at any age. In 2017, the government introduced an overseas transfer charge. Now, this only applies if you transfer your pension to a country in which you're not going to be living, unless both you and the pensioner are in the EEA, which Australia is now part of the Eurovision Song Contest, bizarrely, but it's not part of the EEA as far as I am aware. So yeah, it has to go to the same country as you, but that's not a problem with Australia. You can have a Qrops in Australia, as long as you don't then move on to another country within 5 years, then you're fine. And back in 2017, the Australian government also reduced the amount that you could transfer into Australia in one go. I mentioned just now about the amount that you could transfer each tax year. That reduced it. When I first started doing this job 12 years ago, it was $180,000 that you could transfer in each tax year. It then went down to 150, then went down to 100. But from the 1st of July this year, it's actually gone back up a little bit. It's gone to 110 now. So hopefully it will continue to go in that direction going forward. If you've got a much larger fund, don't worry about it. It doesn't mean we can't help you. There are options, and we are very used to managing people that have particularly large funds, where that becomes a real restriction. But there are ways that we can deal with that. Okay, so in terms of the benefits of a Qrops, well, first of all, you'll be transferring your pension scheme to a scheme that overseas that is approved by HMRC. Well, not approved, but HMRC are happy for them to accept the funds and happy that they will do necessary reporting within 5 or 10 years afterwards. It means that your fund will then be in the country of your residence. As I said earlier, move it into Australian dollars. It gives you some real benefits as far as that's concerned. Okay, so I am nearing the end now. I am aware that I'm over time, but we were having the technical issues, hence why there was meant to be another BDH Sterling speaker today, but he had real technical issues, so apologies for that. So going through the transfer process. So this is the way that you would work with BDH Sterling. First of all, contact us. I'll give you contact details at the end. We can arrange to speak. We can arrange to have a no obligation meeting. They tend to be over video meetings at the moment, and possibly going forward. It's a changed world these days. So we can have a good old chat about your circumstances. You can find out more about what we can do for you. And then if you ask us to then actually do some work for you, whether it's just pensions or it's a full financial plan in terms of investments and life assurance and things like that, then we can do that for you. We will then we'll work with you, find out a lot more about your situation, go and get more information about your investments. We will do all of our necessary analysis, and then we will present our recommendations to you in a report, discuss it with you, and then agree on the next stage of it. If we have made recommendations to make changes to your financial assets, then you can then ask us to implement those on your behalf, and we can do all of the legwork as far as that's concerned. So why should you seek advice before you make any decision? Well, I've already mentioned just now that there have been a number of different changes to legislation over the years. I've been working with pensions for 25 years now, and I've seen so many changes during that time, with the pension legislation, with more general financial legislation, and that's just the UK. Australia does the same, and it's important to understand how those changes interact with each other between the two countries, and therefore so you make the right decisions around that. If you were to get it wrong and you were to accidentally break UK pension rules as a result of doing something, well, either you'd end up with paying that 25% overseas transfer charge that I mentioned just now, or you could end up losing 55% of your fund in tax. I don't mean that to scaremonger. There should be no reason for that to happen, but it just shows that, you know, if you get it devastatingly wrong, then it can be a really big tax bill that you'd end up paying, which is going to really affect your retirement as well. And we can also help you to assess whether, you know, just because you can transfer a pension, is it the right thing for you? That's what we will work with you to establish. Because, you know, you can have people in very similar circumstances, but, you know, different objectives, and that might really affect the decisions as far as what's best for your interests. Okay, so just finally, just take you through why would you use us? BDH Sterling, we are licensed in, regulated in both the UK and Australia. We are the only financial advice planning firm that has chartered status in both countries. So a bit like your chartered accountants, we're educated to the highest level in both countries. And we have 3 offices in Australia, and we can do everything for you, basically. We can take you through what happens with your UK assets. We can help you to establish yourself over in Australia, not just the Australian end of a pension transfer, but helping you to set up new superannuation schemes over there, life assurance, mortgages, anything on the financial side. They can do a proper financial review for you and point you in the right direction. You will find that a lot of the companies that you are used to dealing with, like your Avivas, your Standard Lives, etc., in the UK, they will be different companies in Australia. A bit like the big 4 banks in Australia are ones that you don't find necessarily elsewhere. So you know, if they can help you navigate that, what might be quite confusing system when you first arrive. So the UK office can help with the UK assets, and then we would gradually hand you over to the Australian offices who could help you when you arrive over there. So hopefully you should find that it's a fairly seamless approach, delivering advice on both sides of the world for you. And as it says there, we've got 15 years experience in UK pension transfers. I think actually the directors have a little bit more than that now. As I said, I've been working in this this particular field for 12 years. So we do have some decent experience amongst us as far as doing with this is concerned. Okay, so if you do want to chat with us, what you need to do is to send an email to us at inquiries@bdhsterling.com. Just give us a brief overview of what you're looking for, and then one of the advisors will be in contact with you to discuss your individual requirements and see how we might be able to help you. And then obviously we can then go further by setting up a proper meeting to then you know, really dedicate some decent time to finding out more about each other before you then decide whether or not you're going to use our services. Yeah, hopefully that gives you a good idea. So we are now moving on to the questions and answers session. So Mike, do you want to come back in now?
Yep, no problem.
Excellent, and we'll take you through the questions and answers. So please do ask your questions. We generally find with this part of the webinar that a lot of questions do tend to come out as we go through it, and sometimes the question and answer session can actually be almost as useful as the content of the webinar in terms of you know, getting really helping you to understand what the situation is. So I'll first of all I'll pass any over obviously to you, Michael, if there's some on the currency side of things. So please feel free to ask Michael the questions as well. So I'll go through the questions in order that we've got here at the moment. So the first one is from Timothy. He said, "I'm interested in finding out how to transfer military pensions." Well, I mentioned earlier the Armed Forces Pension Scheme is one that you can't transfer in its entirety. If it's already paying to you as well, even if it wasn't the military pension, you wouldn't be able to transfer it in its entirety, but you will still receive the income. You will have to account for it in Australia on your tax return. Everybody has to do a tax return in Australia, like in the UK. So you will have to account for that pension in there. But Michael, maybe you can tell him a little bit about what you can do on the currency side of things for ongoing pensions.
Yeah, of course. So we've got a number of clients that often BDH can't help because of sort of service pensions, but we can help move those funds across on a monthly basis for you. And on the regular currency transfer, you can actually do a fixed rate as well. So, say for example, sterling Australian dollar did go back above 2. You could have that pension amount transferred into your account every month at the same exchange rate for the next 2 years, for example, which again is good for sort of planning ahead, so that you don't have to worry about currency fluctuations when moving your pension across, because you're just getting that same amount moved across each month. So that's generally sort of the approach. So at least we're moving a bit of risk from the situation when you've got no choice but to get paid out on that pension in the UK as sterling.
Yeah, and that's exactly the situation that my parents-in-law were in when I recommended your services. So yeah, I know that it is very useful for people to, and also to have the one point of contact at Halo, an account manager that you can speak with about all the, what's happening with the currency. Is now a good time to lock it in? Can actually get some professional opinion about it. I know that can be really useful for people as well. Okay, so moving on to the next one is from an anonymous attendee, and it says, is there any benefit of transferring a pension to the Australian pension system if it is already being taken in the UK, either as an annuity or a flexible lump sum UK pension? Well, if it's an annuity, I mentioned earlier, it will be set in stone, so you will continue to be paid from your annuity provider. If it's being paid under flexi access drawdown, then that's the sort of thing that you get from personal pensions or self-invested personal pensions. You can set it up as flexi access drawdown. That means that your fund remains invested throughout your retirement or until you do eventually buy an annuity, and you can vary the levels of income that you take from it, a bit like an Australian scheme can. Now, if you're in flexi access drawdown, then you can still transfer. You've still got an active fund there. You can still transfer that to Australia, although we may have some issues with it in terms of rules between the two countries, but there are always methods that we can employ. So if you are in that situation where you've got a fund that's in flexi assets drawdown, please do get in contact, because we will be able to help you on that. Okay, can you please send a link to get a copy of the presentation? The presentation will be available afterwards. It is being recorded. Hopefully they can get rid of the beginning bit where we were having technical issues. But it is being recorded. Yeah, if you drop an email again to inquiries@bdhsterling.com and just ask us for the link, then we'll let you know when it's available. It only takes a couple of days usually for that to be available. We quite often have people approaching us in advance to say that they can't attend, and we can send them out a link for it when it's ready. So, Timothy, if military NHS pensions can't be transferred, how can we claim them? Well, the main thing that you need to do is just keep in contact with the pension provider. If you keep in contact with them, then they will write to you ahead of your retirement, usually about 4-6 months ahead of your retirement, to let you know what your options are as far as to how you take the pension, usually in terms of any lump sums that might be available and the annual pension that you take. Yeah, make sure that you keep in contact with the pension company. They will then know where to write to, and at the necessary time your pension can then be put into payment. As I said earlier, people tend to find that keeping a UK bank account open is useful. If you have your pension paid directly to an Australian scheme, the likelihood is two things will happen. One, it's being paid on the same day every month. You have no idea in advance what the exchange rate is going to be on that day. And secondly, most likely when you get paid directly into a bank account in Australia, you will get bank rates on the exchange, which are basically not much better than tourist rates, the sort of rates that you get at the airport when you go there. There are some exceptions to that. There are some banks that do offer good rates, but as Michael mentioned earlier, find out what what sort of rates that your bank does offer, and compare it with Halo, and then you will be able to pick and choose the rate that you get, but only if you're having it paid into a UK bank account first, and then getting it paid over. So if you keep a UK bank account open, that should be fine. You can't generally keep savings accounts open, but you can usually keep a current account open. It does vary from bank to bank though, so do check with them, and if necessary, take out a new bank account before you leave.
Yeah, and essentially those current accounts, if there's a standing order going out each month, then we've got guys that have moved to Australia a number of years ago and still just have a UK bank account running along in the background. So yeah, it's not usually much of an issue, to be fair.
Yeah, it's what I generally tell people to do. So Graham has asked one for you, Michael. He said, regarding regular currency transfer arrangements, do you need any specific arrangements with the banks or account types at either end?
Yeah. Oh, so that's what I was kind of alluding to. I think I might have jumped ahead a bit there. So yeah, essentially, if you've got your current account still open in the UK, if you're doing a regular currency transfer with us, then yeah, you essentially just have a standing order set up, and on the same day of the month, funds arrive with Halo. I mean, we generally say leave a little bit of a buffer in there. A lot of people sometimes leave that buffer because every now and again they want to come back, or they've got family members in the UK they want to send a bit of Christmas money to and things like that. But yeah, for your month to month, you literally just leave a current account open and set up a standing order with us. And yeah, as I said, we've got guys that have been doing that for 10 years and still moving funds across with no issues. So yeah, nothing special in place, just your UK current account really.
And of course, that is the beauty. If you do keep a UK bank account open and you're coming back to see family, and you need to convert some Australian dollars to top up your UK bank savings, then obviously you can use Halo in reverse and get a good exchange rate on that. So Steve has asked what the costs associated with Halo
are. So our profit's just built into the exchange rate that we offer you. And as we said, we encourage you to check with your bank and compare it to ours. So ours still does have the profit built in, but it's generally significantly better than what you might be getting elsewhere. So from there, we then don't actually charge any fees. If it is below £5,000, then there is a £15 transfer fee. But other than that, no fees from ourselves. When you receive funds into an Australian bank account, unfortunately, there's not much you can do to avoid some receiving fees at the other end. It's pretty standard for all Australian. I mean, we've worked with them all over the years. It is pretty standard for Australian banks to charge $20-25 to receive funds into the account, but it's always a fixed fee. So there's some countries in Europe that charge a percentage, which can get pretty nasty on larger amounts. But if you're moving money to Australia, no matter what you move, you're looking at that about $25 or so. Other than that, no fees from ourselves.
Yeah, and I believe it's still the case that banks in Australia will charge for using each other's cash points. So people say to me, "Well, I've got an HSBC account and it's international, and I've seen that there's a couple of branches in Australia, so I can just use HSBC." The problem with that is, unless that branch is round the corner from you, if you do want to withdraw any cash, I know cash is a bit of a dying thing these days, but if you did want to draw any cash out of the cash point, then you will most likely find that you're having to use a different bank's cash point, and you will be charged for doing that. So that's why a lot of people tend to go with the big four banks out in Australia in terms of where they set up their accounts. Okay, so moving on, Graham, you've asked whether cashed-in ISAs are subject to tax when you move the money to Australia. So ISAs are obviously very tax efficient in the UK. If you cash them in while you're still in the UK, there is no tax to pay. If you're moving it straight over to Australia, there's no tax to pay on that transfer. If you were to leave the funds in the UK for quite a number of years, and you made a gain on the exchange rate, you may end up being subject to some tax. But there are easy ways to safeguard yourself from that, and we can help you with that. It's very easy. But yeah, no, there's no tax charge as such. Now, if you were to keep your ISA and then move to Australia, that's when ISAs are not so tax efficient, because the Australian authorities don't recognise the tax-free wrapper that you have there around the ISA savings, and they will look straight through it and say, if you've got cash and you're earning interest, I know that's a bit difficult to do these days, but if you do earn interest, then you will be taxed on that as interest in Australia. If you're in a stocks and shares ISA, you will be subject to capital gains tax on the gain. So ISAs are not necessarily as tax efficient when you move to Australia. But having said that, they don't really have a nicer equivalent in Australia either. But if you've got significant money, it might be worth looking at other options, like, for example, an offshore bond, which can fall under a different type of tax in Australia. And as long as you hold it for 10 years or longer, any gains that you make within that will become completely tax-free. So if you do have surplus money you're not going to need to touch for 10 years, that can be really useful. Okay. So, Katie, how long before we anticipate our visa being granted should we be talking to BDH and Halo? Well, I'll talk about BDH first of all. As soon as you want to. Now, in terms of people that are moving to Australia, we have people that are approaching us and moving next month. We have people that are approaching us because they might be Australians in the UK who are planning to go back to Australia in 5 to 10 years. But they want to start working with us so that they can look at how they start positioning their assets as they start to accumulate wealth, as they're building up pensions and other investments. Are they putting the money in the right place? Are they taking advantage of all of the things that they can take advantage of? Like, for example, I mentioned tax relief earlier on contributions. The opportunity over multiple different tax years to get additional contributions into your pension, get that tax relief that you will never give back because you're going to get tax-free benefits in Australia. That sort of planning can be really useful in advance. So really, it's a case of when you're ready to speak with us, speak with us. I generally say that it's good if we have at least 6 months to work with you, but it's not disastrous if you come to us later than that. How about you, Michael?
We're very similar boat, to be fair. So yeah, I mean, the better you plan, generally the better it works out. As Paul says, we've got guys that are sort of going on parent visas that it's going to take them 5 years until they're going out there, but they want to start planning ahead. But equally, we've got people that may go out on a spouse visa and they're going out next month to get married, and all of a sudden they need to move a fair chunk across. So yeah, it's really down to your situation. What we say is get on our books, make an inquiry, so you're kind of getting some updates from us. And then if you say to us, oh, I don't need to speak to you for 6 months, then fine, we'll set a task further down the line. So get in touch straight away. But yeah, it's really depends on sort of when that visa comes in. When we really start moving money across, again, is relatively similar. Sort of 3 to 6 months before you go is when we start looking to really sort of place orders as well for your average customer, if you like. Yeah.
I think that's important. You were saying, just get in contact. I'd say anybody that has been watching this webinar and thinks, oh yeah, that could be something that's worth talking about. But you might think, well, I'll talk about it in 6 months' time. Well, just have an initial chat with us. We can then work out whether there might be some opportunities in the shorter term, or it might well be that if you're speaking with me about your situation, it might be that I turn around to you and say, actually, let's catch up in 6 months. It's just a case of having that initial contact, so that you can then work out yourself, when you want to take it, more seriously with us in terms of actually employing our services. Okay, so Graham, you asked about if you've if you're trying to keep a UK bank account open for your state pensions or other things coming in, don't you need a UK address in order to keep the UK bank account open? Well, you shouldn't do. You need to speak with your individual bank though as to whether they are going to be happy for you to keep your current account open when you leave the UK. But assuming they are, then you just keep them updated with your current address. You don't want to be keeping a UK bank account open with an address that is not yours, because that's not great. You'll have statements going to somebody else rather than yourself. Okay, Phil, can you take a DB pension in the UK and then DC in Australia? Well, if you have a defined benefit type scheme in the UK, and assuming you haven't actually started taking the benefits yet, then it is worth exploring with us whether or not you should be looking potentially to get a transfer value from that, where we can do proper analysis for you to work out whether it is in your interest to transfer it to Australia. It can be. In quite a lot of circumstances, it can be with Australia, because you're taking tax-free benefits at the end. It brings down the level of investment growth that you need on it compared to if you were living in the UK and you're comparing taxable scheme to taxable scheme. So yeah, you can transfer a DB scheme out there. We would need to get transfer value first, do proper analysis. If it's worth over £30,000 when you get that transfer value, you have to have UK regulated financial advice anyway. That's a government requirement that, if you're looking to transfer out of that scheme, you have to employ a financial advisor to give you the advice. Obviously, with BDH Sterling, we are financial advisors who also happen to know about Australia. So, in terms of the projections that we do when we're looking at that sort of thing, we are factoring in you transferring it to Australia and taking the benefits from an Australian scheme in the future. So the analysis that we do would be a lot more relevant than you would get from a normal financial advisor in the UK that doesn't necessarily have those capabilities. Okay, so Doug, if you're currently under 55, is it correct that you would need to leave your current personal pension pot in the UK and that any growth would be taxable at 15% in Australia? When you reach age 55 and are still in Australia, can you therefore transfer your pot to Australia and access it tax-free? Yes, so your pension pot in the UK will continue to grow tax-free up until the point you transfer it. At that point, any growth that you've achieved between what it was worth when you first moved to Australia and what it's worth when you transfer, that growth at that point when it goes into Australia will be taxed. It will be taxed at 15% if the scheme in Australia pays that tax from the fund. You can elect for it to be paid through a tax return if you feel that you're going to pay less than 15%. Of course, in a lot of cases, people would pay more than that. And also, if you get the transfer wrong, you would have to put it through your tax return anyway. The scheme in Australia would not be able to pay that tax on your behalf. But we can make sure that we get that right for you in terms of making sure that it is only accessible to 15%. But again, you're keeping 85% of the growth that you achieved during that time, and then you're getting everything tax-free in your retirement. So it's still not a bad deal, particularly compared to some other investments. Simon's asked a question here, Michael. This is going to keep you on your toes. How do Halo conversion rates compare with Wise?
Yeah, so essentially, of course, that they're a competitor of ours, and the products that we offer are pretty similar, and as are exchange rates, essentially. Wise is a little bit more pushed towards online transactions, and we're generally slightly more personal service. So it's this kind of thing. Maybe with small transfers, yes, they're very good, but we like to pride ourselves on, when you're moving your life assets across, that there's someone that you can literally pick up the phone and start speaking to straight away, because payments do get held up from time to time, and normally it's a very menial reason why that's the case, but we can fix those issues very quickly, whereas some other places you don't necessarily have instant access to someone that can fix any issues that you might have. So yeah, it's that personal service. You're moving everything you've ever earned and moved across in one go. Having that extra human touch, in our opinion, makes a big difference. So yeah, essentially the rates pretty similar, but yeah, we just pride ourselves on that extra consultative approach.
Okay, great, thanks. Next question is, what should I do if I am less than 55 and want to return to Australia with no plan to return to the UK? Well, that's fine, and that's why, one reason why it might be worth transferring your pension and other investments over to Australia in due course. It's not about what your intention is, though, as far as the legislation is concerned. You just can't go until you reach age 55. It's a rule that HMRC in the UK imposed. Just to give you a very brief outline of why that was, HMRC started taking a closer look at Australian schemes and realised that they could pay out benefits under the age of 55 in circumstances other than serious ill health. So in the UK, you can only have benefits earlier if you're in serious ill health. In Australia, serious financial hardship as well as one of them. There are some other ways that you can access funds under the age of 55. And HMRC basically said, no, we've provided tax relief on these contributions because it was to save for your retirement. And therefore we are going to impose the minimum pension age, just like in the UK, to Australian schemes. So you can only make a transfer to Australia once you're age 55. Now, I reiterate, as I mentioned briefly earlier, that is likely to go up to 57 from 2028 because the minimum pension age from a personal pension in the UK is going to go up to 57 in 2028. So that it's 10 years below the state pension age, and it will probably continue to change according to what happens with any further changes on the state pension age as well. That's worth bearing in mind. Steve, you've asked who the big four banks are in Australia. Well, I was conscious I mentioned it a couple of times and didn't say who they were. Michael, I'll let you answer this one. I'm sure you know who they are.
Yeah, no, of course. So, you've got Commonwealth Bank of Australia, who claim to have the most amount of ATMs in the country, so that sort of helps with the cash side of things. You've got Westpac, it's another one. Then you've got NAB, so National Australia Bank, and then ANZ is the other one as well. So ANZ, NAB, CBA, and Westpac. They're like a 3-letter acronym between them. But essentially, those big four, it's like going with Barclays or HSBC or NatWest. They probably are pretty similar over the wall. We do work with CBA a bit more, but your choice to go with which one you want, essentially.
Well, and as I said, it depends on where the branches are and where you're living as well. It's funny because obviously for a lot of people they will never have heard of those four banks before, and that's what I was saying about the financial side of things earlier as well. You probably won't have heard of the superannuation providers over there, or various other companies. They are the other side of the world. They've got different situation, different companies running out of that country. It's, as I said earlier, it's one of those things that we can help people to get familiar with when they arrive over there and setting up the right accounts with people, etc. Steve, you also said that you missed the comment about what address to use for the UK bank account. Basically, what I was saying is use your your address at that time, just like with just like if you were living in the UK and you were moving from address to address, you'd let the bank know what your new address is. Doesn't matter that it's an Australian address. That's not going to affect the ability to keep the account open, as long as you've checked with your bank before you left the UK that they do allow you to keep that account open if you move abroad. So that looks like that's all we've got in terms of the questions and answers for today. On that note, unless anybody very quickly pops a question in there, I think that's time to wrap up. So thank you everyone for staying on today. I hope that you found that very useful. As I said, the recording of this will be available later to watch at your leisure, and in case you need to sort of fast forward to the end to see what the contact details were again. But again, our contact details at BDH Sterling are inquiries@bdhsterling.com. Michael?
And my email address is michael.hart@halofinancial.com.
Perfect. Okay, well, so if you do have any questions at all, want to discuss your specific situation with either of us, then please get in contact with us, and we will then be happy to answer those and set up meetings, etc. So yeah, thank you very much for your time tonight, and we shall say good night.
Yeah, thank you very much as well.
Good night.